Have you gotten to your stage of your personal finance journey where you paid off your debts except for your mortgage and you're looking for ways to use your money to make a better future for yourself and your family? Well, today we're talking about stage four, which is exactly that phase of your journey towards financial independence. We're looking at what do you do with your money when you've gotten to the point that all your debt's been paid off except for your house, and you want to make sure that you build some wealth to retire early or enjoy life with your family or leave a legacy for future generations. My name is Jordan. I'm your host with Couples Create Cash Flow here today. Certified financial coach, and I'm looking for ways to help people understand the journey from the starting point of personal finance all the way through financial independence. So today we're jumping into stage four of the five stages. Let's do a little recap. So far, we've done videos on stage one where your cash flow is negative, and so we need to decrease expenses in order to get our cash flow to be equal or positive, slightly positive. Stage two is we look at how do we create a buffer in our finances in order to be more aggressive towards paying off debt. And so stage two is to get a little bit of an emergency fund established. And the way we do that is by increasing our income. We have to find a way to go above and beyond what we normally do in order to have some extra funds available to save. Maybe we sell something or just get that money saved up as quick as possible. Stage three, once we get to that point where we have positive cash flow, we try to maximize our cash flow and use our extra money each month to pay off things that have an interest charge to them. So this would be looking at credit cards, student loans, other kinds of consumer debt, car loans, that sort of thing, and finding a way to free up even more monthly cash flow by paying off the debts, and then therefore those payments are available to us to use. If you use the Dave Ramsey debt snowball or the debt avalanche or velocity banking, all of those tools rely on the fact that you're creating more cash flow by paying off these debts, and then you're saving yourself a ton of interest along the way. Stage four is when you have paid off your debts, you don't have monthly payments towards purchases that have some sort of interest charge, but we do have our mortgage still, most likely. Now we start to have to think about, well, what's the best way for my money to work for me? You may have heard you have to have money to make money. You may have heard the idea of passive income, where you just kind of stockpile some money and eventually you can just live off of that stockpile. I mean, that's essentially what the retirement funds are all about, right? You stockpile a bunch of money during your working years, and then you live off of those dollars throughout your non-working years. And in that way, you're able to still survive and maintain the lifestyle that you want. And so once you get to this phase of life, usually you have created a buffer for yourself. You've created a savings plan, and you've got some positive cash flow, and you're probably not as stressed as you used to be, but you do have kind of this lurking feeling that your money sitting in a savings account making less than 2% is probably not the best way or the wisest way to manage your long-term wealth building strategy. So today we're talking about buying income producing assets. So once you've got everything except for your house paid off, now you can really have that extra money available to put towards buying assets. Most of the time, we do not buy assets. I mean, I was at this phase of my own journey. In my earlier years of marriage, we were basically just spending all of our money on consumable things or on monthly payments, and we didn't really have any money that was going towards anything that was producing some kind of return. And so this priority in this stage is all about using our freed up cash flow to buy things that will continue to produce money on a monthly or quarterly basis. And if you've never read Rich Dad Poor Dad by Robert Kiyosaki, I would highly recommend that you do so. That's the book that most people start to get familiarized with the idea of what is an asset and what does it mean to invest. And so his definition here is an asset is anything that puts money in your pocket, something that creates a positive cash flow for you. And so there's a couple different ways to look at building wealth. One is that accumulation method where you're trying to stockpile a bunch of money in retirement funds or stocks. And the other way would be looking at how do you create more cash flow in your life where it's not that your time is creating your income, it's that you bought an asset that is working on your behalf. And then as you build a system of assets, you're able to stop working at your job because your assets are actually paying all your bills. That would be stage 5, and we'll get to that in the next video. But for today, the 3 main topics, the 3 main areas that I want to focus on for assets would be stocks, real estate, and businesses. And I just want to say right now as a disclaimer, this is not a form of investment advice. This is purely educational. I am not a licensed financial advisor, and I cannot manage your funds for you. You need to do the best you can to get educated in videos like this about what your options are in order to start investing your money wisely. So with that being said, most people will try to maximize their 401ks or their Roth IRAs or other kind of retirement accounts. And that's because it's set up that way in most of our jobs that our employers provide these retirement plans, and we can, decide how much money we want to take from our earnings and deposit it right into those retirement funds. And it's one of those kind of foolproof ways of making sure that you have some money saved up because you never get to touch that money. It just goes straight out of your paycheck. And for some people, that's actually better than nothing, right? It's better than not being able to say that you have any money saved up. But there are some drawbacks, and these are some of the things that I want you to look at is if you have all of your wealth building energy put into your 401k or your Roth IRAs, you're going to have to be prepared for the emotional roller coaster that you are going to be on when you get closer to the retirement years. Just this last couple of years, we've seen the market go down and up in quite drastic ways, especially during the COVID pandemic. So what I would say is there is going to have to be a long-term plan for how you want to manage those accounts and what you're going to do to kind of prevent that emotional distress that comes with the volatility when the market goes up and down. You don't want to get to that point in your life where you're about to retire and your portfolio drops 30% and now you can't retire anymore. You got to keep working for a few more years. So really the plan for what you want retirement to look for or look like is something that you have to start planning for much earlier in the process. The other thing you have to look for is most of the time, these retirement accounts do not allow you to have much access to your funds before your retirement age. Now, obviously, if you have a Roth IRA, any of your contributions are available to you, but you can't access the growth unless you want to pay a tax penalty, unless you get into that age where you're over 59 and a half. The other thing that some people aren't aware of is there's also a minimum distribution amount that you hit once you're 70 and a half, where the government will require you to take out your money, even if you don't want to. Otherwise, you'll have tax penalties for that as well. So one thing to just be aware of is what are the rules that are associated with your different assets that you put money into, that you purchase. These 401k plans, these retirement funds, they do a good job of purchasing. Sometimes you have these target retirement dates plans, these funds that will actually balance for you along the way. And so as you get closer to retirement, they'll change what the portfolio balance looks like. So it can be a very nice way to just put your money somewhere and not have to think about it. But one thing that you don't know about until you really do a little digging and you do some intentional research is what is it costing you to just put your money into that account without having to think about it? There are things called management fees, and these management fees do come out of the balance that you have in your account. You may not see it very much just looking at your balance, but one of the things you can do is look at the quarterly reports that you get and look at each fund that your money is invested in and look for that management fee. Usually sometimes you can see fees that are up to 3% or more. And that may not feel like a lot, but if you think about a year when you make, 10% and then there's a 3% management fee, it really cuts into how much you actually made. The other thing is that that's money that's just leaving your system. It's not something that you can really do much about. And so it's a hidden cost that most people don't realize that they have. The other thing is if you have a 401k and you've never paid any taxes on the money that's in there, you're going to pay taxes on the full amount once you retire. And the chances of the tax brackets changing in your favor and decreasing over the next few years is not really that likely. The chances of taxes remaining similar or becoming higher in the future is really probably where we're headed. And so sometimes it can be a surprise to people how much they get taxed on their 401k funds. Now, there's a lot of people out there that kind of switched over to Roth IRAs. There's even a more complicated strategy called a Roth IRA ladder, where you can take a 401k and roll it over to a Roth IRA. But there are some very specific rules about how you do that. And I would definitely consult an accountant about that and make sure that your taxes do not get messed up too badly if you do that the wrong way. The other thing that's good to know about is that you can decide what you put your retirement dollars towards in these accounts. So there are different funds. There's different mutual funds within these companies that you can purchase, and some of them do have lower fees. And especially if your employer is with the Vanguard model and even some of the other ones, they can sometimes have fees that are lower than 1%, even more like 0.1%. And so if you can go through the options and choose some stocks that have lower management fees, that can be a really huge impact on you if you think about the compounding interest effect over time. So I would just really encourage you, if you do have some retirement accounts with your employer or even past employers that you're still maintaining, go into each fund that your money is invested into and really look and see what are those costs of those funds to be actively managed. All right, the other thing to know about these funds is that they're really focusing on compounding the stock shares that you own. They're not really designed to give you cash flow. They're not designed to put money in your pocket on a regular basis. They're designed to be a storehouse or a warehouse for your wealth. And as a vehicle to do that, they allow that tax deferred status on either the principal or the growth, depending on the 401k or Roth IRA status. And so there is some definite benefits if you're using a Roth. Early on, you're getting taxed at whatever rate you were at. All that growth doesn't get taxed, and so when you pull it out later on, that money is just ready to go, and you can use it. But you do have to remember that in your retirement years, when you do take money from your like your 401k or your Roth, it counts as income. So you got to just be careful about how you plan that out. And two, most people have a hard time saving enough money in their retirement accounts that would allow them to live the lifestyle that they currently are working at, living at while they're working. And sometimes people expect that they could even retire with a better lifestyle than what they're currently doing. And so it's just really important to look at what lifestyle do you want to have when you're retired and how much money will that cost. If you look at, I want to travel, I want to take trips, I want to go on cruises. Well, okay, look and see how much each one of those things costs and kind of put that in an annual spend amount and see how you would break that down on a monthly withdrawal rate from your retirement accounts. And if that would match up with a safe withdrawal rate that would allow you to still have money at the end of the day. The other thing that these things get eaten up with is medical bills, nursing homes, basically any assets that you have that can help pay for those end of life care things can certainly be tapped into. And so it can sometimes be that you don't quite use your money the way you think you will. And most of the time we're living longer and later in life than we thought. And so sometimes that's another factor. So all that being said, that's kind of the traditional route for buying assets. A lot of people will say, you got extra money, just funnel it into your 401k, funnel it into your Roth. Try to max out how much you contribute to each one of those per year. And, that can be a good strategy for some people, especially, the employer match is a big deal. A lot of people talk about that. But personally, even though my employer offers a match, I do not contribute to my employer's retirement funds because I want to be able to direct where all of my money goes. And when I am putting it on ice for, however many years until I get to 59 and a half, it doesn't allow me to do anything with it right now. And with the education that I have, I would much rather have access to that capital right now and be able to use it to my advantage. Because if I can buy assets now, then the cash flow that those assets produce are going to provide me with income to live my lifestyle when I'm retired. So I'm calling this non-traditional, but I will say the other way to look at this is there's an accumulation way to retire, and there's more of a cash flow way to retire. And so the accumulation way would be, okay, what's your annual amount of expenses? So just for a round number, let's say that your annual expenses are $100,000. Well, then you're going to want to make sure you do the math to say that you can pull $100,000 out of your retirement funds and that the interest, the growth on that account is going to be able to make up for that. And so for most people, that's, have a couple $1,000,000 in the bank or in the retirement funds. And as you pull out that money, the money that's still there will keep growing. And hopefully the growth on that will keep up with the amount of money you pull out. And there's a whole topic called the 4% rule, which we're not going to get into right now, but the 4% rule is all about a safe withdrawal rate. There's a lot that's been written about that, blog posts and that sort of thing. So if you're interested in that, I would highly recommend checking that out. But I'm looking at this more as a cash flow retirement. So instead of saying I need $100,000 a year, you would then break that down, say, well, how much do I need per month? And then you'd say, okay, well, if my monthly expenses are X amount, let's say $5,000, then you would get to the end of it. Well, it'd be more than that if you're 100. If you get to that point where you say, okay, I want my monthly expenses to be, let's say, $9,000, then you just have to create enough, or you purchase enough assets along the way, or create enough assets along the way that pay you enough money per month to where you don't have to work at all, and that the money that comes in covers your expenses. It's a different way of looking at it, and it doesn't have as much to do with how much money is sitting in an account somewhere. It has more to do with what purchases have you made of assets that actually do throw off some income. All right, so two of the biggest ways that I look at this, because first of all, let's talk about the money that gets pushed off or comes your way with all three of these main topics. So there's the stock market. There's not a lot of cash flow in holding stocks. There are quarterly dividends typically for some accounts or some stocks, but it's not usually enough. You have to usually hold on to quite a bit or have a lot invested in order for that to be what covers your expenses, because usually it's about 5% at the very best, 3 or 4% at the norm, that you would get back for the amount that you're holding on, and that's coming in a quarterly rate. So if you had tons of money, that would be one way you could live off of the cash flow from your stocks. But most people, if they hold on to stocks, they're going to be selling those stocks in order to be able to pay for their monthly expenses. Well, with rental real estate, it's a little bit different. You can do a lot of different strategies to get into this, but for most people, it's going to be buying and holding. So you purchase a property, you get a renter, the renter goes in there, and they pay you monthly rent payments, which creates kind of a steady income. And if you can figure out your financing such that you can pay it off before you retire or around the time that you retire, then you have no mortgage payment, and then all the money that you can make off of that one rental would just be part of your income. So for example, if you get a house, let's say a $180,000 house, and it rents out for $1,200 a month. I'm just making up numbers here that are similar to what I've seen in my life. $1,200 a month, but your mortgage is like 900 of that, or maybe even 1,000 of that. Once that drops off, the $1,200 a month, you'd want to save a little bit for repairs and that, but you might have $1,000 from that one property coming through each month. So paid off assets are part of the strategy. You just don't need to have as many rental houses if you need to cover your expenses that way. So in this example, if you had 9 rental properties where their mortgages get paid off right when you want to get retired, and you cash flow $1,000 for each one after the mortgage comes off, it would really be all you need to pay for your retirement. Those paid off houses have a value to them, so you could still sell them if you want to, but really the value is in the amount of money per month that they would pay you. And so then your main job in retirement is to manage these properties, or pay a property manager to do that for you, and just kind of go off and do your own thing. So for most people that I've looked at or listened to, read about with this strategy, sometimes it's about buying some distressed properties, fixing them up, flipping them, gaining some capital, and then getting into these longer term strategies where maybe you have a duplex or a triplex, or a 4-unit, or maybe even a small apartment building, and then you just have one place that all of your real estate money has gone, and that's how you kind of consolidate it. But for other people, it's just buy a bunch of different single family homes and really build up your cash flow that way as well. This strategy, or one of the strategies I didn't list here, is the BRRRR method. And I did do a video on how I've used a HELOC to do the BRRRR method for my first rental property that I bought, and how that was actually kind of a cool way to use the strategy with a HELOC, which actually most of the time people that do BRRRRs, at least the methods that the bigger pockets folks talk about, don't usually involve using HELOCs, but I've actually talked to a few people that say they've used that as well. But the other big thing you can do, something that creates cash flow on a monthly basis, is business ownership. So you can either start a business from scratch, whether that's creating a product that you can sell, or providing a service to someone. Usually these are much more active, especially at the beginning. You're not going to have a lot of ability to just walk away from it and have it produce income. But there are some different types of businesses where this could be more passive and it could be more automatic. You just have to really be creative and very intentional about how you structure it. The other thing you could do is purchase an existing business and then grow it from where it's at. There's a book called Buy Then Build by Walker Deibel. I read that. I really thought that was a pretty cool idea to create cash flow, because when you're purchasing an existing building or business that already has some inventory or equipment as an asset, the bank will lend to get you into that business, and then the monthly payments you make towards the bank are typically less than what you would make for the cash flow. So you can just by taking out a loan and getting into a business that you have some understanding of, you can really get into that asset category quite fast. You don't have to have an original idea and come up with an original product or an original service. The other thing that I think some people get hung up on, and I have myself when it comes to businesses, is trying to be so unique and so creative that you come up with something that no one's ever heard of, or solve a problem that no one's ever solved before. And that's not exactly what we're talking about here. We're actually better off to create something that's already been done and just do it slightly better. Or provide a service that other people don't really care to provide. It can be lucrative to just mow people's lawns in the right way or wash their windows. It doesn't have to be very complex, but what it does have to do is it has to be able to scale to a level where you're not the one doing all the work all the time. That's where it goes from being self-employed to being a business owner, is if you have a system in place where other people work for you and create the revenue for the business. And then that way you, as the owner, are managing the system and not so much out there doing the work. And before we move on to this slide, one great resource for that topic would be the Cash Flow Quadrant by Robert Kiyosaki, where he kind of talks about the difference between being an employee, self-employed person, business owner, and an investor. I really like that book as well. All right, so here's 2 other concepts. So one of the biggest problems that people usually have when they look at, well, how do I buy an asset if I don't have any money? hopefully by this stage of your journey in your finances, you do have some monthly money that's coming through, but maybe you haven't actually stored up enough of it to feel like you can go out and buy a rental property or purchase enough stocks to really make a difference in your monthly cash flow or feel like you have enough saved up for retirement. And so one of the things that people don't usually think about until they start learning about it is um, the equity in your home. So if you do own a home and you've owned that home for at least a couple of years, you probably have some equity in that home. And the equity is simply just the difference between your loan balance and the value of the house. Now, when you just buy a house, especially with a 30-year mortgage, there's not going to be a whole lot of capital or equity there, especially if you don't put a whole lot of money down. Some people are getting 10% loans or down payments, 5% down payments. You're just not going to have enough money for or enough equity to get a HELOC. But when it comes to Velocity Banking, you can tap into a house that's almost paid off, or half of the way paid off, or even a third of the way paid off, and have some money available to you to then purchase like a rental property. Most of the best deals for rental properties are distressed properties that you need to pay cash for anyways. And so if you can tap into some funds that allow you to make that purchase, then it gives you the ability to go out and get into this category of assets. I'll highly recommend that you do a lot of research first and you know what you're looking for. But in general, using a HELOC properly is one of the best ways to get access to some funds once you know that you want to use it to buy an asset. The way I like to think about it is that equity in your home is kind of like an investment that you've been making every single month. And when you use a HELOC, you're actually tapping into some money that's been frozen and making it liquid again. And when you use it to purchase an asset that creates a cash flow, you can divert that cash flow back to the HELOC to pay it off. Or if you do a fix and flip, or you purchase it, fix it up, then refinance it with the BRRRR method. If you ever have a lump sum of money coming back with like a cash out refinance or monthly cash flow, that can just go to pay off that HELOC on a regular basis or pay it off all the way. The cool thing about a HELOC, you don't pay any interest until you use it. And so even if you just open it up in a second position, so you still have your mortgage, open up a second position HELOC, and now you've got $20,000 you didn't have before, $30,000 you didn't have before. If you find a deal that it would allow you to, put 20,000 down in order to get into it, 30,000 down. Now you have the money that you didn't think you had before to get into a rental property. The other thing to look at is a concept called the infinite banking concept. And this is something I don't have enough time to get into today, but it's a way to store capital and then use it, having a compounding effect as well as the death benefit outside of the tax code. So it is a specially designed whole life insurance policy with a mutual insurance company. It was designed through the work of R. Nelson Nash, who wrote the book, Become Your Own Banker, Unlocking the Infinite Banking Concept. Very good 98 page book. Highly recommend it. But really the theory is about how do you tap into the equity that you have in your life. So just like a HELOC taps into the equity of your house, infinite banking taps into the equity that you have in your death benefit. So if you buy a whole life policy, it actually pays out guaranteed when you pass away versus a term policy, which will not pay out guaranteed. Some of you don't know that, but most financial gurus will say, don't ever buy whole life. It's a terrible product. And for the most part, I would agree with them, except for when it's designed specifically to be a place to store your wealth, like the infinite banking concept teaches. So that is another way to tap into some equity or some capital. This strategy takes a few more years to prepare for because you do have to put some money down on the front end in order to start building a cash value in your policy. However, it has very favorable terms when it comes to taking that money that you put in and using it. And so I would highly recommend looking into the infinite banking concept some more, especially if you're at this stage where your cash flow is looking to buy assets. Some people would prefer to actually just to send their cash flow towards a whole life policy and then use the whole life policy to buy the asset. And that way you're kind of getting a 2-for-1, because you can use the money inside the whole life policy to go buy a rental property, and you get the benefit from both of those two things. You just have to send your money to the whole life policy first. I have a policy like this. I've been paying it for 4 years. I used it to purchase a business. I used it to purchase an RV, a vehicle. Like, I've just got nothing but the best things to say about this concept. As long as you know what you're doing, do a little research on the front end, and find a great insurance agent, it can really be a big game changer when it comes to this stage of your finances. All right, so the ultimate goal of stage 4 is to use your cash flow to purchase a system of assets. You probably can't get by with just one, that would create enough additional cash flow through your passive income that would allow you to not have to work, that work would be optional for you. So what this requires is that you pick an investment strategy that you can understand, and you learn the ins and outs of it. You figure out how to implement it for yourself, and then you go all out. You put that money towards the assets, because when you purchase an asset, it pays you back by definition. And so you really have to make sure that when you're putting your money towards something, it's going to actually gain some money. It's going to either gain value, or it's going to give you monthly cash flow, or both. So this is where you don't want to use that extra money to go buy a brand new car that drops 30% in value, and you drive it off the lot and will never pay you monthly cash flow unless you use it as a leased vehicle that you're going to lease it out to somebody else, right? All right. So here's some action steps. I would say pick an asset type that you're interested in and do a lot of research. YouTube's a great place. I've done a lot of research for real estate investing, business ownership, stock purchasing on YouTube. Just find some channels that's all they do, and really listen to them. Get down a basic strategy that somebody's telling you about, and kind of look and see if it would fit your lifestyle and what you're good at, and then look at which path you'd like to take. Start doing that. Take your money out and actually put it towards that strategy and buy some assets. You won't really learn the way you need to learn until your money's on the line. I mean, I found that out, especially with investing in stocks. It's really hard to know what makes the market go up and down, or what affects the industry that you're investing in, until you put some money into that and you start to watch the news and you see what makes it go up or down. You watch for quarterly reports, that sort of thing. It gives you a lot more education than if you're just sitting on the sideline with no money at risk. Same with real estate. You may learn a lot of different things about being a landlord and flipping properties or buy and hold strategies, but really, until you purchase one, it's really hard to know what you don't know. And a book's not going to teach you everything. You have to learn some things from life experience, and choose to fight against analysis paralysis. I mean, the fact that you're watching this video means that you like to learn, and you probably hop between a lot of different channels, learning a lot of different things. But at some point, you got to synthesize it all together and take an action step and do something to get that money devoted to purchasing assets, and try to make sure that you continually look at new ways to be efficient, because the more efficient you can be, the better the outcomes long term. All right, so as we come to the end of our video today, I just want to say, if you need a guide, I'm a certified financial coach. I'd be happy to help with you, help you with your journey. Doesn't matter what stage of this journey you're on, but I'd love to help you get to the next stage. I'm offering a 30-minute consultation call for free if you want to just get to know me a little bit, see if we'd be a good fit. And I do have a form that you can fill out if that's something you're interested in. I also have a free guide called The 3 Steps to Start Velocity Banking. It also comes with a HELOC checklist for finding a good second position HELOC. So if you do want some free information about velocity banking and see, how would I get that started, and what would that look like, especially if you're looking at buying assets, I'd be happy to have you download that. Free download. It's in the link. The link is in the description below. So that being said, I wish you the best as you work through this phase of your financial journey. And stay tuned. We have one more stage here, stage 5, where we look at what does it look like to really get to financial independence. Thanks.